The last 2 days we've had testimony from Chair Yellen on the Hill with our distinguished, or in some cases not so distinguished, representatives in government. And all they ever seem to do is prove just how dumb they really are. That's probably why Congress's approval rating is as low as it is. Anyhow, wouldn't you love to hear me asking Yellen questions, the kind of questions I would ask her? Anyway, yesterday, she was asked directly about raising interest rates, and she was, I think, the consensus on TV with the talking head seems to be that she was a little bit more hawkish than not. I don't necessarily know if that's going to be the case, but sure, why not? Let's just go with that narrative for now. So the Fed has been telegraphing that they're considering doing three interest rate rises, whichever way you want to count it, this year. So that would mean every press conference meeting from now until the end of the year would have a rate hike, correct? With the press conference afterwards saying, how to justify it. They've talked about their normalized rate, the end target rate being lower than normal. The Fed usually seems to bring it all the way up to 6% before you get some kind of catastrophe. They seem to be wanting to stop around 3.5% this time. Seems reasonable to me. That was actually if you go in the Wayback Machine and you look at some of my old videos, really old videos, and even some articles and tweets I've posted in the past, I've mentioned that I thought that would be the end target rate before they even announced it. So based on I do a lot of back of the envelope calculations that I shouldn't say always, but usually tend to be up pretty good. So that was my take on that. With regard to the rate hikes, so I did a poll. This was interesting, and I think this will explain some of the contradictory behavior in the markets. So I did a poll. It was very simple. Do you think the Fed will raise interest rates at their March meeting? 288 people had the inclination to answer. 51% of them said yes, 43% no, and 6% were unsure. I did another poll today. It's still in the works, and so far 166 people have answered. I just retweeted it, so if you're on my Twitter at Justin Pulitzer, please answer the poll. I wrote, how many times will the Fed raise interest rates in 2017? So far, 7% think 0, 23% think 1, 44% think 2, and then 26% think 3. I've been in the 2 camp. I think, though, that I'm open to the 3 camp if and only if we get some kind of crazy employment number on March 10th. Honestly, I mean, the market is at all-time highs here. The Fed might be inclined to do it when they can, not when they have to. We'll see how that plays out. There was some economic data this morning, which I have to be honest, I didn't have a chance to really thoroughly go through. I will cover that in more detail in the weekend review video. So I'm just going to pull that economic calendar up. I want to see what they actually did go through today, and for some reason I'm not seeing that. So I'm going to give that about another, well, let's see, economics. Oh, here we go, economic calendar. I just get this from Bloomberg, by the way. No mystery as to where this stuff is listed. So today they had the bank reserve, we don't care about that. Consumer price index. I think that the inflation data and retail sales, which came in better. Industrial production. Yeah, I'm going to have to go through this. Some of this is some important stuff. And the EIA petroleum status report, which is always very interesting. We're at like record level builds in petroleum, and we're still seeing oil hold it together, which is pretty interesting. So let's assume that the Fed, I'll give you the scenarios of what I think is going to happen here. So I said that I thought, it's interesting that I said that the 44% only think 2 hikes and 26% think 3 hikes, but 51% seem to think we're going to hike this go. If you look, and this is what the big tug of war has been, at the CME website, they have a probability of the actual hike based on bond pricing. And yesterday it was 17.7%, and today it jumped to 26.6%. So what is that telling me? What does this all mean? What is the meaning? It tells me that the market got a little off sides here and has probably underpriced the probability of a Fed rate hike. The Fed has done this in many, many meetings before where there has been a lower probability of a rate hike, and they don't like that for whatever reason. I guess they want to remain relevant. It's sort of like the poke me, pay attention to me like a little kid. And I think that they want to stay relevant. They want to keep all meetings live. None of the language Yellen used yesterday to me, I didn't notice anything different. I tend to notice things. Sometimes they're a little esoteric, but they usually tend, again, to sometimes be tells. And I really didn't hear anything. So my guess is that the market is going to pull a, I gotta think of a name for this, but the market is going to wake up and realize it has under discounted the probability of a rate hike, and there could be some type of a quick, short spike up in interest rates that gets everyone freaked the F out, and then that's that. So we're going to have to see how that plays out. So how do we judge? How do we trade that? Well, the answer is easy. TLT. So TLT has a very key level here. Today was actually a break of a slight channel. I'll show this again in the weekend review video on Sunday. And the high of day was one tick above the Fed day high, and it went lower. So what does that mean? It means to me that we can play it either with a buy stop long above today's high for a rebound, with obviously a stop below today's low, or we could play short below today's low with a stop above today's high. So that's a quick short-term play. I've been thinking that rates were going to try to come down a little bit, but I think that the Fed is trying to talk up the probability, so maybe it does want to take the next move lower and finally get the primary trend touch. It had used to be about 1488. It's currently around 1517. So maybe there is some type of a look below range to trend, and then it kind of finds its footing. Like if you're going to buy bonds, you're usually a longer term type of person, right? And you might say to yourself, let's maybe just hold off a little bit until we get some more clarity on the Fed, because if you're going to buy something and the Fed is going to hike, it would automatically hurt your situation. So my thinking on TLT, like I said, is for a quick trade, I like above today's high long with a buy stop. The 50 MA is right below us. Today was technically yesterday we closed below the 50, and today was the kind of continuation down, but we did close within the range. So what I would do it in two parts. One, if we lose the low, it's a short, and we probably can play for at least a retest of the old low. If the move is higher, I would buy stop over today's high of day, and then I'd be looking to add over 120.30, which was yesterday's high of day, because it was a hammer. So above like a 2-day range, particularly if it happens in gap fashion, I think it could be quite dramatic. So we're going to have to see how that plays out tomorrow. So that's TLT. So to summation, a long story short, I think that the market underpriced the probability of a rate hike, and I think that you're going to see that probability is going to come up into the Fed meeting as people realize they either need to square positions or put hedges on. So I don't necessarily know that they're going to hike, but I do think that the street might start factoring in the probability of a hike a little bit more seriously. This is also not, when I talk about bonds, it's very hard for me not to talk of the dollar. I had said in the weekend review video and a couple of weeks ago that we were due for a somebody just typed something. I didn't see exactly what it was, but it looked interesting. If you could retype that would be great. Something with 110 in there or something. Anyway, I've been saying that I thought we would get a move up in the dollar. We were potentially having a head and shoulders pattern. Today's candle actually was quite bearish in the dollar. So if you follow along on the chart on 2-2, you had a look below and fail, and I believe I had said that I thought that that was going to be the onus for a move higher. That is happening. We're stalling now on the old channel. Again, I will show this in the weekend video, and we're getting close to forming potentially a right shoulder here. If we were to blow through and get above the head, I've said I thought, and that's 103.82-ish basically, then I think 109s are in play. But until then, I'm going to assume that 102, and maybe even lower, maybe even today's high, could be the end of the dollar bounce. So yesterday was a look above the 50-day MA and fail. Today was a look above the 50 MA again and fail. And we closed back into the prior day's range. So I'm not keen. I'm thinking that the dollar bounce here could come to a bit of an abrupt end. If you're looking for a quick trade, I think you could probably be short below today's low tomorrow, or if you think that we're going to have a little bit more bounce up to the 102s, I don't think I would buy stop above today's high, because I could easily see this going and then kind of coming back in. I'd really need to see the full head and shoulders pattern fail. So I'm looking for, let's say, a short below the low today, and then I'd be looking to like add to it if it could break 100 again, let's say, because I think that's going to be a really key level. If it's too firm, it shouldn't really be seeing lower. A lot of people have been asking me about the metals lately. I've been a little shy about talking about it, but I am long silver. I've been long silver for a while. I have short puts. I actually have been adding slowly but surely. We are getting close to the downtrend. So here's the scoop. The downtrend coincides with the 50% fib, which is 1726. I'm talking SLV terms here, but I like that we're kind of just chopping below it. So if we kind of just grind to it, it might not be as dramatic as it would be if it was like a straight shot there. So I probably will be looking to book some profits on the touch of it, but I don't know that I would clear it all out. I like now that we have now 2 days closing above the 200 MA, and I think you can use yesterday's range as a guide. So below 1681 would be a good, I guess, cautionary area, and I'd probably be looking to stop out if it lost 1669, somewhere between 1675 and 1669. But over 1712 should, I might even, as crazy as it sounds, might try a quick add on the position with a tight stop. That's my story with SLV. GLD is sort of similar in nature. You have the breakdown took place from the 100 MA, and that was on 10-3. This is the first time we've been above the 100 MA for a while, and it's been supporting. So I'm fine with GLD as long as the 100 MA set holds. If you were to lose 16-15, I'd probably be interested in a stop out, or maybe even a right or right out short. So that's the story with GLD. GDX. Everyone wants to talk about the miners. The miners broke out a while back. They're futzing around the 200 MA. They actually they keep closing below the 200 MA. I'd be into buying a dip on the miners if there was a retest of like the 50-100 MA area. I like now that for the first time in like a really, really long time that the 50 MA is bent up. The 100 isn't bent up yet, but it's flattening. So, and the 200 here has flattened out quite a bit. So I'd be into buying a dip, I think. I don't necessarily know if I want to chase the miners. They're into some reference resistance here and pulling back. So I'd either buy stop it above the recent swing high, 2571, or I'd wait for it to come back somewhere into the 50-100 MA confluence. Wow, we're getting through some good stuff here. A couple of trades that I'm in that no one mentioned, so I hope some people took these. You know, it's funny. Today was a weird day for me. I have some positions on that aren't ones I necessarily talk about that much in the weekend video, just because they're not really as well-known stocks, but sometimes I see them and I tweet about them. And I had on Restoration Hardware. I had bought this on, what was the day I bought this? I bought this on 2.9 on the, like, if you go back and you look on the chart, 2.7 and 2.8, you had bottoming tail hammers after a gap down of the low end of range, and then you had a move above those two hammers, which to me is an automatic long. The following day, you had a downgrade by this company who's quickly becoming my least favorite. I think that some of their calls have been pretty, I don't want to say, I don't agree with them. I'll keep it politically correct. I don't agree with their calls. And the company I was talking about, if you just look, it's Buckingham. They've come out with a few calls lately that I don't know, I just don't agree with. They could be right, but in this instance they weren't because the stock went higher. But it caused a liquidation break in the stock at the 10-day moving average, which has been some resistance. And I was pretty close to stopping out of this. I had put my stop below the first hammer, but it didn't take it out, and it bounced. So I stuck with the trade, and I mentioned in the weekend video that if we got above 26.26, which was the high of day of that day, that I was going to double my position. And I promptly did yesterday, actually, on the break. And then today we had this very nice gap up by Wedbush. They did an upgrade. So what was crazy to me also about the Buckingham downgrade was that they downgraded the stock, but they left their price target $20 higher than the stock is trading. So it almost is a double of the stock, but they're downgrading it. I don't. That to me didn't make much sense. I mean, the stock was at the time of the downgrade, like if you took the close, they did it intraday, I think. So it was like only like 20 in the 25s or 26s, let's say. It had to be, I guess, at the high of day. So the 26s, but they left a price target of, I think it's like 42. Okay, I mean, hey, I'll take it. So anyway, I added. Today you had a gap, a look above the trend line. It came back down, and it went through the open, and I was debating stopping out, but I looked at the chart, and I saw that the 20-day moving average has been the tough resistance to get through, and I was willing to hold it as long as we were above the 20 MA, and that touched and rejected higher. And I'm still in that trade. So what am I going to do now? Everyone wants to know, what am I going to do now? So first of all, the whole premise of my trade on this was to just catch a rally ahead of the earnings. I really hope that it just keeps going higher so that I can get out ahead of the earnings, but who knows? So what I'll do now is I would double my position again above today's high. Maybe not double it, but I'd add to it. I don't know if, like I said, I don't think I would double it. I would just add to it, maybe a third more, because we do have 50 MA resistance coming up, and there is some reference supply in the 30s. Below the low, I'd probably either stop out of the, I don't know about the entire position, although maybe, but because I do have that great trade location and I'm trying to hold this, but I might stop out of half of it. So today's range to me is very key. The gap today, the low of day of the gap was 27.45. So if we start, like, let's say tomorrow we were to not take out the range, but we closed below there, I would be really cautious. I'd be a little bit more cautious. But I think the close was kind of okay today. And that's it. That's my thoughts on Restoration Hardware. Another one I was in was Groupon. I've oddly traded. If you go back, I have a really crazy story with Groupon. If you look up my name in advanced Google search and you look up Groupon with me, there was no ticker. This was before it even came public. I had said I couldn't wait for it to become public because it was going to be a perma short for me. And I have a very long history. This is like one of the old, this was like maybe my original silliness stock, for those of you who have been following me for a while. The silliness stocks were GoPro and Fitbit and all that crap. when they were at the highs. I remember having a conversation with a trader I happen to respect quite a bit, and I think the stock was like near 100 at the time, and I was just like, this thing is going to go to single digits, and sure enough, it did, and I basically ridden that call the whole way down, with some minor allowances for rallies. Anyway, Groupon. I had been long this a while back, and I had sold out, and I had never looked at it again. When did I sell out of this? I don't even remember. It was a long time ago. The stock was like up a lot. I think it was in the $5 something range. And I had set an alert. I think it was at the gap fill. Yeah, this was it on this day here with the gap fill. 357 or something was the gap fill, and I had put in an alert to buy it, and I think I bought it a little bit even lower than that, but I definitely bought it that day, and I've been sitting in it, and it's just been kind of like playing games and shopping, because Groupon, while it's not a great company, it's probably not a zero. There's some value there in their hills, as they would say. And today was a pretty nice gap up in the right direction. I'm thinking that this actually gapped and closed above the interim downtrend. The next real resistance into the gap would take, you need to get above 484. So what I might do with this bad boy is I'm looking now to just sell it at the gap fill, which would be to 526. I actually have a sell order in around there. I might even front run it by a cent or whatever, because those were old reference lows. That was really where it broke down from also. It's a gap and an area from where it really broke down from. So I'm fortunate enough to be in this. I'm going to try and I didn't even realize it was earnings, but honestly, when things are they had a pretty good number. The expected estimate was losing like 2 cents and change, and they came in with a 7-cent profit. That the stock deserved to be up. So I'm thinking that area is where I'm looking to get out of these things. It was funny. I was laughing about it when I bought Groupon. I had the order in, like I must have put the order in a long time ago, and I heard the chime, and I'm like, ay. I'm like, once bitten, maybe I hope I'm not going to, play this, and then I'll get in just in time for the thing to go to zero. But I stuck with it. I even had forgotten, and I noticed today I got an alert when the thing gapped up. I was like, whoa. So anyway, that's the story with the Groupon. I covered Restoration Hardware. Another one of these. Yeah, I did get a haircut. Thanks for noticing. Twitter. This has been another one of my little dumpster diving expeditions. So, and I detailed this one on Twitter. I was pretty clear about this. 1569 to me was had to be the must hold, and it went below it. It had basically a double bottom, and I said anything over 16 was a long, and I took it, and the stock went up. Today it was announced that Jack Dorsey, the CEO of Twitter, bought the stock. He actually finally put his money where his mouth was, which is good. There was some bemoaning. Some people messaged me, and I saw some articles online. I think I read like 2, that now that he bought it, they probably aren't going to be for sale. Listen to me, and I know this is going to be very hard to understand, but you don't want to sell right now. The asset is not performing well. The price that people are going to get that they would get for this stock is going to be bupkis. They're going to they'll probably have tons of shareholder lawsuits, and they're going to have a hell of a time getting that thing sold, in my view, for anything more. I mean, the last time that had the run up, it tapped out at $25. So, are you really buying Twitter at 16, hoping for $10? I think that I would be happy if this thing sold for $46. But you're never getting that now until they return to growth. So they need to start, and they need to start, 1, growing their user base, 2, making more money, and I think 3, I think what might be interesting is if they did some type of strategic partnership with Google. Like if they didn't sell the whole thing, but sold a piece, like a capital infusion. That way, I think you'd finally have a floor in the stock, and you'd know it's not going to be a zero. And I honestly believe this. I was very against Twitter and Google buying Twitter. But now that I look at how Facebook bundles their sales of their product, I think it would be a good sale for actually a good deal for Google, because they could make more money out of Twitter than Twitter can make on its own, because when they're bundling ad sales, they can put in a check Twitter box and bundle it up that way and make more money. It could be accretive probably almost right away. So, and by the way, I mean, honestly, at this point, I mean, how could the damn company be managed any worse? It's just a, it's been a total debacle. But anyway, above 16, I'm going to stay long. I would stop out below the recent low. This is one I'm trying to ride. Alrighty, Apple. So I have a couple of things to say about Apple. One is that if you go back on my Twitter feed a while back, and this was before this thing just completely went gangbusters, I mentioned, and this was really before the rally fully grabbed, it was like kind of after the gap in the Trump, but we were chopping. I said that I noticed that there was either a buyback program going or a large buyer sitting on the bid. Any downtick, I was noticing that buyer come in and chomp up shares. Now, how did I do this? I just watched the price action of the market. Days that the market would pull back, Apple would be strong, and you'd see intraday downticks with the thing getting bought up. When you trade a stock long enough, or you've been in the market as long as, I mean, it's crazy to say as long as I have at this point, you start getting to know the behavior of stocks and situations and see how things are working, the mechanics of the market. And I could tell by the way Apple was trading that it was being accumulated by someone big. And yesterday it was disclosed that it was Warren Buffett. He bought 42 million shares of the stock. So that is the answer. Warren Buffett was buying the stock, and I picked up on it. Buffett was able to do it in a way that most people did not notice it, and I think it went under the radar to the point where people weren't able to capitalize on this. I think that also he did it in a way that disguised it. They did it very intelligently. Other than maybe one day or so, and I don't even know if it was him, they cut their buying near the end of the day to make it look like the buyback. You don't get to be one of the richest men in the world being a schmo, right? And letting everybody know. I mean, if Buffett was going to buy 42 million shares and you knew that, or knew he was accumulating, what do you think would have happened to the stock? It would have run the hell up on him, and he probably wouldn't have been able to get his full position on. So the moral of the story is if you can look at a stock and see what it should be doing, how it should be acting and how it shouldn't be acting, you can start to pick up on things like this. The next time I notice this in a stock, I think I might even be more aggressive about it because it worked out so well here, particularly with Apple. What now, though? Here's the problem for me with Apple. While I liked it down much lower, I'm starting to not like it as much now higher. I'm hearing guys on TV who hated this stock now use it as their final trades, using it as guys who were talking about how the thing is over now, are all hopped up about the company and the cycle. So you came from the bottom and now you're at the top and you're above the old reference high. The stock is still behaving really well. I can't say that it's bearish, but I can say this, that you had a doji topping tail, sort of like that gravestone doji at the top of a range today above the old all-time high. So I will say this, if you've been long Apple, I think you could use, and I don't care if it happens in a gap, but a loss of today's low, you probably want to book profits, or if you're aggressive, put on a right or right out short trade with a stop above today's high. I don't think you're going to get the full gap fill right away, but I do think you can get a test of the backside of the old channel, which happens to be the earnings gap high of day of 130, and it would be, it's better than a sharp stick in the eye to bag 4 points. So we've reached my 2 times range move. We reached the old all-time high. If you're, like I said, if you're long, just trail up the stop. I think you could use the stop below today's low, or again, if you're aggressive, short. I would be interested in buying this on a more significant pullback to, again, buying it again at the 50 MA. So I don't know if, like I said, I don't know if that gap, I mean, the gap might eventually fill. I don't know when it would, maybe next earnings. The problem for Apple is that the next couple of quarters don't tend to be good for Apple. They don't have holiday sales, and everyone starts waiting for the iPhone 8, and we all know the iPhone 8 is going to be some kind of new form factor, and it's not going to just be an S upgrade. So I have a feeling that this could be it could be a long wait until that September area. So I do like buying dips or bigger pullbacks in the stock, but I have a very hard time chasing it, considering this rally really, I mean, depending on where you started this from, you could say from either 104 or you could even say as low as 91. So, I mean, the stock is back to the old all-time highs. At the very least, I like the idea of booking some profits here. And that's, like Forrest Gump would say, that's all I have to say about that. I don't talk about Baidu very often, but somebody asked, so I will oblige. This is one heck of a choppy mofo. Let's see. This is why I don't really like this stock, because it is so choppy. This is just in a consolidation wave here, in my view. Let me look on a longer time frame. I think that I'd be better off mentioning this in the weekend review based on what I'm seeing in this. You had a head and shoulders pattern at the top, a pretty nasty breakdown, and now you're just in a flag formation. And is the flag, let me see, is the flag hasn't even broken yet. So what I would say is you're in a narrowing triangle here in this stock. It's a big one. I might post this chart, actually, for people to see, because this is going to be very powerful when this does break, either up or down. But you are in a sorry about that. I had a call coming in, and I had to decline it. Don't people know I'm doing Periscope? So the answer is going to be this: is you've got to break this wedge, and I think the break of the wedge will be go with either up or down. I don't want to predict which one it will be, but when that wedge breaks and we're getting close to the narrowing, I think it could happen on earnings. So if earnings is a gap above trend, it's probably one you can go with. If it's a gap below the line, I think it'll be one that will have legs lower. If you must do something now, you look like you're in a bit of a pullback phase, I would probably buy it somewhere near the 200 or the 100. The 200 or the 50 MA. If you want to be aggressive into earnings, you could sell a put spread, a bull put spread, meaning selling those puts and then buying ones lower. But I'm waiting for that triangle to break, and I will post that. I will post the triangle on Twitter in a little while. Starbucks. This is one I have not been a huge fan of for a while because of Schultz leaving. It looks like it's trying to repair, oddly enough. It's had a couple of these look below trends and fell. Also was a kind of a head and shoulders pattern. It's pushing up against the channel high. It's looked above the channel high a couple of times and fallen back. If you're going to be long this, you're coming into the 50 MA, the 200 MA must hold. That was where was important support. It had been resistance, and I think it now has the support. So if you're long Starbucks, I would be looking to book it either at the gap fill, where I'd be interested in a right or right out short play, or if you're long, you would want to either stop below the 200 MA, or if you're aggressive, you could short below the 200 MA. So that, to my eye, is the key, that 200 MA. So let me see. I want to just pull up some other stuff. There was a few things I had wanted to talk about. Maybe we'll end on that because I do have to get booking here. But there are a couple of things I do want to discuss. I was asked a couple of questions today about the VIX, why the VIX was up, given the market was higher. I think it could have been a combination of three factors, however, the American three or the German three, however you want to do this. I think the issue was a combination of three. One is option roll. You have the expiration coming up in 2 days, and I think that there was some rolling in that. I think also with the market being at all-time highs, people don't want to be the guy who bought the high and they're buying puts to hedge their position. It could also be a combination, when you start getting into a euphoric phase of people buying calls. You could actually either have shorts who are, trying to cut off their ability, or people chasing, and they know that premium is cheap and they load up on the calls. You remember what I talked about being in pure directional play here? I think it's hard to go to your clients and say you're not participating in the rally, but you also don't want to buy the top, so I think that could have been a combination of those things. Also, the VIX inherently has an intrinsic value. It's usually between 10 and 11. Anytime we've looked below there, it's been unsustainable, and I'm talking about from 2007 on. The only time when I could remember up until recently we looked below it was in 2007, and that wound up being the low of the VIX, and then there was the financial crisis. So that area is kind of a sacred cow. It doesn't really go that much lower. So I think it was just a function of it bouncing off the low. The VIX could continue to rally. One thing that has me concerned, though, and I won't deny this, price is truth, is you did have the VIX rally when the market was going higher. That is a bearish sign. It's not something you want to see if you're long in the market. So what do I think? I can tell you this. It's hard to be a top caller, but it's also hard to not take advantage of a VIX this low, and take advantage I did today. How did I do this? I've been doing these, I call these the green room trades. Where does that come from? It's actually a term from The Color of Money. By the way, I'm a huge movie buff, if you haven't noticed. They talked about the money isn't made in the tournament, it's made in the green room. So what I've been doing is buying put spread overwrites. I did this a couple of weeks ago. Obviously, they didn't turn out to be winners, but I wound up selling so many overwrite puts, I think I actually made money on the trade even though it didn't go down. So that's why it's the green room, right? The real money isn't made in the tournament, it's made in the practice room where you gamble for money with other players. So what is an overwrite? So here's an example, the one I put on today, and I've been really kind of fancy pants with them too. I've been going longer dated. I still have, this is just what I have on. Today I filled in May, 93 days to expiration. It's a little longer than I'd like, and given where we are in the range, I'm starting to think maybe I went a little too long. But I'll give you my inner thought process of why did I do this, right? I'm almost like, why did I do this? No, so I bought 234, 225 put spread in May, 93 DTE, with an overwrite in the April 215 put, 65 DTE at 215s. I also have on 225, this was the older one, 225, 220 with March 211 overwrites, and I may put in more overwrites in that too. So I'm calendaring it off. I'm making the overwrites in more near-dated months. Why am I doing that? For two reasons. One is it's hard to call the top, and I don't want to necessarily have that premium outlay. Also, remember when I put these on, a lot of them, only until today, I've been saying the market is going to go higher. I've been long. These have been hedges or just cheap short bets. So I did them longer dated because I didn't think they'd pay right away. And I knew I could make money on those overwrites to kind of get the cost of these put spreads down. The overwrites have not been able to make them credits right away. They can. I did have them that first one I discussed. I forgot who I discussed this with. The one I did, the 225, 210, at the time it was, I actually have rewritten the 210s twice now. I had one expire worthless, and the other one is pretty close to getting there. So it could actually not only, believe it or not, be put on as a, for nothing, but it might actually be profitable. It may even be at this point. I have to go back in and look. But today we reached my target that I discussed in the weekend review video, and I've been discussing for weeks, and that was 234.03, and I actually put this on above 234.03. So what's my thinking? My thinking is this. One, we reached my target. We're above the channel high. We're at the backside of the old progression line. We're at the 1.618 Fibonacci extension. The VIX is, touched below 10 the other day, and it's now rising with a rallying market. And I think that we've had multiple days up. Am I going to be right? I don't know. Could the market go higher? Yeah, sure. Why not? But I was able to fill this for cheap. And if the market goes down in any real major way, I'll make a heck of a lot of money on this. The danger I have is if it completely collapses. I mean, like really big time, big league down. Too far, too fast. Why do I not think that will happen? For a couple of reasons. One is the 50 MA has not been tested once since the breakout of 11.9. So I think at the very least the 50 MA will also be coinciding close to the breakout around 228. 222 is a gap fill and will soon be the 100 MA. And the big breakout was over 219.60, and the 200 MA, by the time it could ever get there, would be close to there. The channel low would probably be close to there at that same time. So I don't see there being a ton of risk on the overwrites. The spreads themselves, and by the way, 210 to 11 was huge. It took so long to get through there, and if we got down there, I can't imagine that not being a buy. It's also basically a gap fill of the entire Trump rally, which started from 208.55. I'm doing the overwrites in more near-dated expirations in case I get in trouble. I could always roll them down and out into longer-dated expirations, and then even if I want add size. What you want to do when you're buying premium is buy long dated, and when you're selling, sell near dated. So that's my thinking on these plays. This one I put on, I think it was $1.83. I think they filled that today. I'm pissed. I could have filled them so much better toward the end of the day, but it's all right. It's really no big deal. I will be either looking to do overwrites on those, or wait for a pullback, preferably for a pullback to do more overwrites on those. So, but that is what I'm thinking. Where would the overwrites be? At the necklines, I'd probably be looking at like 217s. If I could get money, if still at 215s, I'd do 215s, 217s, 219s, 220s, in that area where I know the reference support is. So that is going to be where my overwrites are. And there's still juice in these because they're longer dated. So that's what I'm thinking. If there's some decay, I can maybe roll up, either roll the overwrite up, meaning close the the ones that I sold. I forget, what did I say? They were 211s, and sell the 215s or the 219s, or just outright sell those and put a stop on either those or the lower ones. There's so many different ways you can do this, but that's sort of the mechanism of how my brain thinks. So those are active plays I'm in. The market is overbought stochastically. It is not overbought on the money flow index, though, which is astounding to me. I know everyone is like, oh, the market is so crazy overextended. The 20-day moving average is down at 229. We're a little bit extended here, but it's not as crazy as people think. And 229 and 228. 34 to 229.71 was a breakout, and the 50 MA is right below there. So yeah, there could be a pullback, but I don't necessarily know that there's going to be like some complete collapse. I do think that what will happen when the market does wind up pulling back is there'll be some kind of a break, some chop, and then maybe some continuation or an attempted rally to a lower high, and then a break, and that's when I'd be getting super short on a rally to a lower high and then take out the prior swing low. That is when it's going to be, that this day will come, I assure you. I don't know when. That would be when I do it. So these are cheap bets that I've been putting on on the ride up to hedge longs, which I've been caking on, and to just put on cheap short bets. Well, I mean, why the hell not? So that's the way I'm doing it. We're into some areas that are important to me. Why didn't I do this in huge size up here? I've done that before at 1.618 Fibonacci extensions where I've gone like full bore, and they've turned out to be some really, really big money makers. Why did I not do it now? Because I see a couple of things in the way of a bigger collapse. One is you have an improving economic situation here. We're not going into recession. Two, you have tax cuts coming, you have repatriation coming, and you have deregulation coming. Those are very positive for the market. Also, you have to look at market mechanics. We are entering an area soon where there could be a market pullback, a narrow window, but we've had a major outperformance in the market in the first quarter. There could be, if there is a break in the market, there could be end of quarter window dressing that would buoy the market. So I find it really hard to believe that if there is a decline, it's going to be a complete catastrophe. You're going to have that going for you. This is the alternative. If we just keep going and gun it, you will have an end of quarter lock-in that could lead to a very nasty correction, that could lead to a very nasty summer correction. So those are a couple of things that are on my radar right now that I will elaborate more as we get into it, as we churn through some of these levels, as I'm noticing price action, as I'm noticing like Apple was the leader, remember, on the way up before the rally really took off. What happens if the market keeps rallying and Apple starts going down, or you start having breakdowns in big cap stocks that really move markets? These are the things that I want to look at. And I will get into them as they happen. We will do it together. We'll do it together. So that's been my thinking. I hope that I got it into the mind. By the way, rate hikes are going to be great for financials. If J.P. Morgan goes to $100, which is probably my end target, how badly is the market going down? I mean, this is my thinking. Anyway, if you missed this or you want to watch it again, it's going to be on my YouTube channel shortly. I have to run quickly now to an appointment and for dinner, but after that I will come home and put it up on the YouTube. Anyway, I hope everyone has a great rest of their trading week, and I hope that this video has helped in some way, shape, or form. And if you're not following me on Twitter, my handle is @JustinPulitzer. If you liked this video, thumbs up on YouTube. Please retweet the links, favorite and retweet links, and subscribe so you can get weekend review video updates or when I post any video for that matter. So have a great rest of our week, and cheers.